So in this episode today, I'm going to teach you why real estate outperforms stocks. Let's get started. Welcome back, everyone. So as I mentioned, this is going to be a shorter tutorial as to why I've come to the realization through research that real estate is by far the asset of choice for returns and for risk. But today, I'm going to give you a high-level overview, and I think you'll see that real estate is, in fact, the better option. Now, the first thing I did, right, when I went into this research study is I said, okay, well, I know from other studies at other consulting firms that real estate over the course of 200 plus years has consistently beaten stocks. And I looked into their studies and I agreed for the most part. And then, I said, well, I want a more modern understanding. In the last 30 to 40 years, a lot has changed. And so I want to understand in modern times, does real estate still outperform stocks? And so I went through a deep dive analysis, and I'll put that chart here, and you'll see a few things. The first thing you'll see is that real estate, from a total return standpoint, has outperformed stocks aside from one period, and that was back into 2008, which was a real estate-led recession. But typically, believe it or not, real estate's actually a recession hedge for the most part. And you'll also see that not only was real estate better from a return standpoint, the lines in the graph that are going like this, that equals volatility and that equals risk. You don't want your asset worth to be going like this. You want it to be going pretty consistently. So the more consistent that line is, the less risk you have, and your return in a portfolio is a measure and a balance between return and risk, okay? And as you can see, real estate is by far more stable than stocks. So what I want to do today, though, is I want to walk you through just at a high level, three main components of real estate that drives the overall return, okay? And I've already illustrated here on the board, and so I'll walk you through what I have here. Now, the first one is what is called appreciation. Now, I'm not one to bet on appreciation. I think it's a big bonus if you have it. But what we know from the NAR, or the National Association of Realtors, is that appreciation for real estate has consistently been around 4 to 4.5% across the nation. Now, obviously, each market varies. They're not all going to be the same appreciation rate. For example, Bay Area, San Francisco, San Jose had massive appreciation from 2013 to 2020. Now, that's obviously turning upside down, but in general, that was an anomaly. And I think parts like Austin, Texas will also have lofty appreciation rates that are far above the average for some time. But in general, appreciation rates for real estate is around 4%, okay? So what I have here is the first category of return. And you'll see too, as you go on to each one of these, the bar gets bigger because they make up a bigger chunk of the overall return. So the first one's appreciation, okay? Around 3 to 6% each year, okay? Now, the next one is called what I call equity paydown. And it's an interesting concept because basically what this means is every time your tenant pays you rent, you take that rent and you turn around and you pay your mortgage. Hopefully you have a mortgage out. The debt cost is so cheap right now at 3 to 4% for a loan fixed 30 years. It's silly not to take advantage of the cheap debt. But each time your tenant pays you that rent, you pay your mortgage, on average, depending on the price of your home, you're probably making between $200 to $400 in principal that is going into your account as equity. What that means is if your loan balance is $100,000, right, each time you pay that mortgage, you're lowering that balance by $200 to $400, or essentially getting equity, as we call it. And when you look at that from an overall return standpoint, that's going to be between $2,000 to $4,000 a year in return, just from simply paying your bills that your tenant's paying for you. Now, when you put that into terms of percentages, that amounts to about a 4 to 8% return on your money. Pretty good, okay? So again, appreciation, 3 to 6%. Equity pay down, as I call it, 4 to 8%. Now, the big one here is known as cash flow. A lot of investors that are buying properties, they are looking at real estate strictly only from this one category, which is cash flow. What do I make each month after paying my bills, my mortgage, my expenses, my taxes, and everything else? And what is that versus what I had to invest to buy the property? Now, we know that that tends to be around, in today's market, between 8 to 15%. 15% is probably going to happen in the lower class neighborhoods, the D and the C class. 8% is going to be closer to the standard return. So an 8 to 15% return is what I am seeing in the market for the cash flow return. Now, what's really cool is if you break this down over here, and I'll zoom in here so that you can see all of this. You can see, okay, well, if we just add up all the ranges, what could I expect for a return in real estate? Okay, well, we know we have the appreciation. That's 3 to 6%, okay? We know we have the equity paydown of 4 to 8%. And we know we have the cash flow, 8 to 15%. So the way you would do this is you would simply add up the category here and say, okay, well, I'm at 3 plus 4 plus 8. So on the low end, you could expect around a 15% annually for real estate. Up to 6%, 8, and 15 equals 29. So up to 29% return on your money. Now, this is what I'll say is that, yes, there have been years where the S&P 500 has, or the stock market has gone up 20-some%. There's also been years where it's gone down to 0 or below 0. And so that's one of the big benefits, is that real estate is pretty consistent, right? It's not as volatile as stocks, and these three components make that happen. Now, another piece of this, and we, again, in our advanced class, we get into this, but tax strategy is a massive benefit of real estate. And it can have substantial returns that are upwards of 10 to 20% on your investment if you do it correctly. So now there are some tax strategies with stocks. It's a little more complicated, but in general, real estate has much better tax advantages. And so that is another piece to the overall return puzzle. But I think what you're seeing here is real estate is a very attractive asset to own from a return standpoint. And this is exactly why I have been so bullish on this asset for many years. So with that said, I'd love to hear what you think about this. And I appreciate you watching. Thanks.